Hi everyone, this is the last video and hopefully the shortest. I kind of tried to save time by doing the first requirement for you before we put the camera on because there is a lot of writing. There's actually quite a bit of writing in each requirement. However, we'll make it condensed. It is a shorter type problem, but again, it brings so many of the concepts in from the chapter. This is like one of your lab problems. This is P5-36 on page 304. They're showing you an adjusted trial balance, and they want you to make a multi-stepped income statement. And that's kind of scary when you see how long Smart Touch Learnings was. It just went on the whole page forever and ever with all those expenses. But this one, they combine the selling and administrative expenses, so much easier. So I'm just going to go over the steps to the multi-stepped. The net sales revenue, right, the 184, cost of goods sold, 85,500 equals gross profit, 98,500. That's what you made before deducting your other expenses, your operating expenses. That's going to give us operating income. Sometimes that's called income from operations, but this book likes to call it operating income, same thing. So they combined the selling expenses to 18,600. They combined all the administrative expenses that don't have anything to do with selling at 12,000. So together they come to 30,600 total operating expenses that I have here. That means operating income, we're not going to answer that right now, is 67,900. But we're not done because we have other income and expenses. We have that interest expense. We don't have any we don't have any sales discounts forfeited in this particular problem. That would be added in here if we did. Like the one I showed you in the end of the last video, that would be an addition here. But we don't have that in this problem. We just have the interest expense. That's a deduction. Expenses are always deducted. If we had revenue from another source, that would be added. So the interest expense is 1,900. The minus signified by the brackets. That's the total. Other income and expenses, there's no income, just the one expense. So that brings us to the bottom line, net income, $66,000. So there's a nice example of a multi-stepped income statement that doesn't go on forever. I actually fit it on this little board. Well, it's not that little, but I wish it was taller. So the second part of this problem is to do closing entries. So in requirement 2, we're going to do the closing entries for Rachel Ray Music. And again, they're really scary and long for Smart Touch Learning because there's so many expenses to close out. In this one, there's only a few because they combine them. So, it's not too much writing and it doesn't take too long. The revenue account, the sales revenue, we have to bring to 0. So step 1 is going to be done at the end of the fiscal year, June 30th. We're going to make sales revenue 0 by debiting it. And the revenue was at 184,000. And again, income summary is going to hold it, just like it did in the last chapter, that holding account for the first 3 closing entries. So we close the revenue to 0 and we let income summary hold it. And usually the second one would be a killer for a merchandising business because it'd be so long, like the one in the chapter. But this one, again, we have 4 to close. The cost of goods sold, the selling and administrative expenses, and the interest have to be 0. So on 6/30, we're going to be debiting our income summary for the total of all of those expenses combined. And that total is 118,000. I already added it. We're going to credit each of the expenses to bring them to 0. Cost of goods sold, selling, administrative, and then the last one is interest. So we only have 4, not too bad. We're going to credit them to zero them out. Cost of goods sold, $85,500. Our selling was $18,600. Our administrative was $12,000. And our interest was $1,900. So that really didn't, take too long, thank God. Another reason why I picked it. Okay, so now we see we're gonna transfer the net income into the capital and zero out the income summary. So we see we're gonna have a nice net income, 184 minus 118, looks like 66,000, right? Is gonna be the net income, revenue minus expenses. I just made myself a little piece of scrap paper. Okay, so in step 3 of the closing entries, we're going to transfer that net income into capital and zero out the income summary. So we're going to be debiting income summary for the amount of the net income, revenue minus expenses, 66,000. A little review from chapter 4. As if we need to do more closing entries, we did enough, right? And then Ray Capital for 66,000. Okay, so we did that. And then we just have to close the withdrawal account to zero. I learned it by the drawing account, so I often call it that. It's supposed to be withdrawal now. So we're going to transfer that amount to the capital by debiting the capital. And she withdrew quite a bit, 40,000. So that's going to be a debit, lowering the capital. Remember, whatever the owner takes out decreases, right? The owner's equity, the capital account. And we're going to credit her withdrawal account for 40,000. And we just did a full set of closing entries just in that little bit of time. I think I need a new marker. Okay, so we've closed them to zero. One more requirement. That requirement is super easy. We just have to do a post-closing trial balance, which would be everything that hasn't been zeroed out. That's the balance sheet accounts, if you remember from chapter 4, assets, liabilities, and capital. The one little trick is they don't give you the new capital balance. You have to come up with that. So before we go there and get stuck with the capital balance, I'm going to do it here. So let's see. We're going to pretend that these all got posted to the T accounts. So let's do Ray Capital. And the beginning balance was $27,350. Right out of the book, right out of the adjusted trial balance. I'm going to put BB for beginning balance, $27,350. Net income gets credited in step 3 for 66,000. And then capital gets debited or lowered by the amount she took out in step 4 when we close the withdrawal account to zero into capital. So this is withdrawal. I'm just going to put with the D. You get the idea. This is going to give us the new capital balance. So what we're doing is taking $27,350, adding the 66 and subtracting 40. So basically adding 26,000 even to this. So the ending amount will be 53,350. And why am I showing you this now is so you'll know where this comes from when you have to put it on the post-closing trial balance. You need that, okay? Everything else is just going to be there. It's going to be super easy. Okay, I'm going to go to the last requirement now. Again, think of how we got this. Plus net income minus withdrawal. Beginning plus net income minus withdrawal equals ending. Okay, last requirement. Post-closing trial balance. Post means after you close. Okay. Everything else has been zeroed out. All of your revenue, your expenses. Net income's been transferred into capital. Withdrawals been close to zero. So for the sake of time, I'm just gonna put RR company, post-closing, TB for June 30. Okay? And we just have to list our assets, liabilities, and our capital with that new balance. I'm gonna abbreviate the accounts, cash, and again, we just take them right off the adjusted trial balance. Was 4,000 debit. This is the debits, and this is the credits. Or these are the credits, I should say. So cash, accounts receivable, 38,400. Merchandise inventory is, again, these are your balance sheet accounts. 18,100, the ones that still have balances that will live on. We still have all our other accounts, they just zeroed out after closing. Furniture, 300. Accumulated depreciation on the furniture. Can't forget about doing that one. Remember credit balance, contra, 8,200 on the credit side. Now we'll have all credits, accounts payable, salaries payable. I'm just gonna list them in unearned revenue. And the last liability is notes. Okay, so I'm gonna put all the balances. Accounts payable, 13,800. Salaries payable, 850. Unearned revenue is 7,500. Am I on the right line? Yes, a miracle. Notes payable is 17,000. Okay, so we're done except for that capital. Ray capital, and again, we would have to stop and wait and figure it out if we didn't already do it before when we were doing the closing, and it's best to do it that way if you need it, and you're gonna need it. If you had to do a balance sheet, you'd need it too. 53,350 is what we come up with. Remember, she started out with 27,350 and basically added 26,000 plus 66 minus 40. So all we have to do here is add up our debits and credits, and they will balance because we have everything on the right proper side. I shouldn't say the right side because there's a right and a left with debits and credits. Assets are on the debit side. Our contra, accumulated depreciation, our contra asset is on the credit side. Remember, that's a contra to whatever it goes with, whatever asset it goes with. And then all of our four liabilities, accounts payable, salaries payable, unearned revenue, and notes, and then Ray capital. Add them up, and I have that total, 100,700. So I think a combination of these 3 videos pretty much covers all the little topics, subtopics in this chapter, because there are a lot of them. So that's why I wanted to kind of throw in some extra. But we're all set, and let me know if you have any questions. Bye.